The McAlvany Weekly Commentary covering monetary, economic, and geopolitical news events.
There are many reasons. Market volatility, central bank artificiality, and now you've got an increase in class warfare incited by the Oval Office. Quite frankly, the danger of the president's narrative is that it solidifies a governmental commitment to keeping as many citizens as possible on a Keynesian consumerist hamster wheel.
Now here are Kevin Orrick and David McAlvany.
Welcome to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany. David, I have mixed emotions this week, okay? I have to admit, I've been getting sick of central bank control and this certainty that's been built into the system and prices being completely wrong, whether it's the Swiss franc, whether it's the euro, whether it's gold, whether it's the stock market. I have to admit, even though there was mayhem last Thursday and a lot of people just took a real huge haircut, I was happy that the Swiss disconnected from the euro and at least their currency went back to what it was supposed to be.
Listen, it's a direct democracy. It's a country that has practiced sound financial management for decades. It is a country that up until recently actually had quite a bit of gold backing their currency, which they don't today. But the Swiss franc shock, which happened last week, I think is consistent with the Swiss bank seeking their own best self-interest and getting back in line with reality. I don't know if this is because they sort of drank the Kool-Aid, so to say, and joined the central bank community for a certain period of time, devaluing along with the rest. It felt like that was the popular thing to do, or the thing that they must do to support their manufacturing sector, but it's gone. And this was, frankly, the most significant currency move since 1992.
Well, and Dave, we were in Switzerland. I remember the week that we were in Switzerland when Switzerland decided to start monetizing their debt. This was 4 or 5 years ago, okay? And we talked on the commentary, which we were recording from Switzerland, about this change in mindset in Switzerland, that all of a sudden they're monetizing their debt. Then, of course, not too long after that, they pegged the Swiss franc to the euro, which basically was saying they would support the euro. They would buy euros and keep the franc from becoming too expensive relative to the euro.
Well, so what happened? I mean, here's basically a brief synopsis. Starting in September 2011, the Swiss National Bank committed to supporting the manufacturing and export sector of the economy. It's worth about 53% of Swiss GDP. And by pegging the Swiss franc to the euro with a target exchange rate of 1.2 francs to the euro, they were going to buttress the manufacturing and export sector. The argument was that the Swiss franc was extremely overvalued. Again, we're talking about September 2011. This is what the argument was. It was overvalued, and it was threatening a deflationary outcome with the Swiss manufacturers being unable to compete in the marketplace because of the currency's overvaluation. One of the primary export markets for Swiss products is the Eurozone. So the devaluation game began then. So 3 years later, we also remember September 2011 for another reason.
Right. Gold peaked.
That's right. It was the month that marked the peak of the gold market at $1,920 an ounce. And here's what's fascinating to me. The same realities which were compelling the Swiss National Bank to devalue were driving the price of gold to fresh heights as investors from around the world sought safe haven assets in the context of global financial instability. And it was at that point felt most acutely in Europe. Now, you can ask, is this a flashback? Do we have current rerun of that same period of time? You know what's happening this week.
Yeah, this week actually is probably something the Swiss saw coming, Dave, and they didn't like what they saw. Mario Draghi is probably going to just open up the coffers and start printing money like there's no tomorrow.
It's back in focus 3 years later to the week. It was 3 years ago that he promised to do whatever it would take to revive the European economy. And 3 years later, he's still dangling the carrot of easy money from the central bank, or as it turns out, probably going to be the national central banks acting as conduits to monetize European government bonds. And so, again, for us, from our perspective, it's no small irony that as we now witness the markets treating the free-floating Swiss currency as a safe haven currency, notice the price has gone up 30 to 40%. Demand has increased. We also are seeing strength in the gold market. Remains to be seen whether the current move in gold is more than a dead cat bounce. That would be the skeptic's view. But quite frankly, if we clear 1347, that would give us an all clear signal. Last week, we progressed above the first hurdle, which was $1,250. And our guess is that the Swiss franc, which closed its valuation gap in a day, moving up 30 to 40%, gold will close that same valuation gap, returning to its old highs within a year.
Let's talk about valuation gaps for a second, Dave, because when something is controlled unnaturally, whether it's the gold price, whether it's the stock price, whether it's interest rates, which are artificially low, there is a phantom gap that starts to occur. In other words, the phantom is what the price really should be versus what the price is being controlled to be. Now, what you saw last week in Switzerland and worldwide through the euro is that phantom gap got filled instantly. And the Swiss franc at one point, Dave, was up 41%. That could take years for a currency. And this all happened within a couple of hours.
That's right. And if you look at sort of the way that the world is constructed, as you expressed a frustration earlier about the central banks of the world controlling prices in so many different areas, and this is what we're seeing and anticipating more of in Europe this week. Because deflation is alive and well, because the Eurozone economy has dipped into recession for the third time, you again have an Italian central banker, that is Mario Draghi, in charge of the ECB. He's primed the investment public for what Italians have had a long history of doing, which is when things are down and out, you just print.
Print money.
You print like men. And that announcement is due out this Thursday. What, when, and how, we can stay tuned. But they've already floated a number. About $635 billion in purchases, and that's been reiterated by several different sources. So they're kind of floating it to get the market used to it. If they want to see a surprise on the upside in terms of market pricing, maybe they'll introduce a slightly higher number.
Just like a bad penny turning up over and over and over. Or I'll give you another example. I never got rid of all my Argentine currency here, my change, and it keeps turning up because I just don't feel like throwing these little coins away, but I'm probably not going to use them before they're completely valueless. Greece, like a bad penny, continues to turn up in the news. I mean, for a few hours, Dave, a couple of days ago, there was a story that said the two Greek banks were asking for a bailout. Strangely enough, that story got pulled off the internet. If it weren't for Zero Hedge having sort of a screen picture of that story, it would have been gone.
It's fascinating that they're back to the same dialogue and the real possibility of choosing to leave the European Union. And this is the same dialogue that was hot and heavy in the summer of 2011. Mm-hmm. And we discussed last week that the Greek banking sector, which for us is something of a small window into the efficiency of the market there, we've already seen $3 billion in deposits yanked from the system. That's in a 2-month period. And as you mentioned, those Greek banks, Eurobank, Ergasias, and Alpha Bank, both have requested access to an emergency cash facility run by the central bank. These things, you would say, were straight out of the press in 2011, except they're not. This is 2015.
Right.
And Mario Draghi's promise in 2011 to do whatever it takes, this is like a broken record. He's been saying this now for 4 years and is ready to deliver on the promise yet again. To what end? I mean, are we really talking about a solution, or are we talking about a Band-Aid? Because it would take significant structural reform for there to be a long-term workable solution.
So this was a 3 or 4 year Band-Aid. In a way, let's say that you were a freshman in college in 2011. And the situation at the time was that people were very worried. They were buying Swiss francs. The franc was overvalued, supposedly. Gold was overvalued, supposedly. Greece was in trouble, supposedly. Then a Band-Aid came along, and now you're in your senior year in college. And it looks exactly the same.
Right. The Band-Aid's being torn off.
Exactly.
You've got the Swiss franc, which is back at 2011 levels.
Right.
Overnight, as investors who've now been given the opportunity to own the Swissy and not just a euro proxy, they've come right back in for the safe haven currency characteristics which that currency has long enjoyed. And we're seeing something of a bid in gold, too, on the same basis.
Well, the Swiss did take action, though, to try to keep the currency from going up even more. I mean, they did lower rates into negative territory, did they not?
To make sure that investors were not interested in owning the Swiss franc, they lowered rates aggressively. Investors were still flocking to the Swiss franc, even though Swiss franc bonds of all maturities out to 9 years are all negative in their yield. So the nominal yield on short rates went from 0.25, that is negative 0.25%, to negative 0.75, 0.75%. They've got 3-month LIBOR, which is fluctuating between negative 0.25 and 1.25. And again, they lowered rates so that investors would say, no, we're not getting paid to own the currency. We're not going to own the currency. They didn't want to see an appreciation of their currency, and yet you did see an appreciation of the currency. What does that tell you about people who do want a liquid pool of safe capital? Who is it that's judging today that there is a need for liquidity and safety?
What just occurred is a picture of what's free, what's been set free, and what is still under control, because they controlled their interest rates.
You're correct. Currency rates are now set free. Interest rates are still subject to the manipulation and control, which the last 7 years have allowed to become commonplace. And in fact, now the market expects it. And that was the big surprise. The market expected, with sort of a hindsight bias, the Swiss National Bank to keep on playing the game that they had been playing. And that's what most in the world assume will be the case with all the world central banks keeping rates artificially low. The Swiss National Bank is still doing that. Global central banking elites are continuing to do that. What happens if or when they step away from the control panel and allow the market to be a market?
Well, let's talk about that. What are the ramifications of the choice that the Swiss National Bank made last week?
You mentioned it earlier. This is in advance of Thursday's QE announcement. So central bankers are preparing for QE. There will be ramifications. It was the Dutch central bank, I think it was economist, if not president, who said, one of the consequences of this next round of QE is going to be that there will be asset prices that don't reflect reality.
Right.
I thought, it's honest, it's true, it's factual. We would have said the same thing. QE distorts asset prices and changes the landscape. That's good for somebody. In this case, the other ramifications, corporations in Switzerland, as a result of the change in the value of the Swiss franc, they quickly moved back towards reality. They had been living in this sort of artificial environment of being highly competitive over the last 3 years because the currency was set low, making their products that much more affordable in the international markets. And so they're dealing now with the hard adjustments. Yes, reality is sobering. Here's what's involved. You've got production costs, which are largely in Swiss francs, and you've got sales, which quite often in foreign currency terms puts them at a disadvantage. And this was immediately recognized last week as even your largest Swiss companies, we're talking about companies that are worth tens of billions of dollars in terms of market cap, they're off 10 to 20% within a 48-hour period. That, by the way, was the largest drop in the Swiss market in 25 years.
But it was built basically with the assumption that the Swiss were going to continue to peg to the euro.
That artificial reality was going to be the only reality from this point forward.
And when I read reports, I was just reading a money manager's annual report, and he was just going, ho-hum, interest rates will stay low. United States is in a recovery. We're going to see new highs in the stock market. We're going to see gold stay relatively low. His assumption is based on really this artificial fix of interest rates.
Being normal.
Now, there's another anomaly that's entered this picture. It's not just the Swiss franc rising, but look who's been buying many of the euros to support the euro.
Yeah, and this goes back to the ramifications of the choice by the SNB, the Swiss National Bank. The euro just lost one of its largest buyers.
Yeah.
You had central bank support for the European currency. That's been very strong. The Swiss National Bank has been aggressively buying euros to maintain that 1.2 peg, which is why the Swiss National Bank records its base money as having expanded from 80 billion Swiss francs a few years ago to now 400 billion. In essence, the Swiss National Bank has been printing Swiss francs to buy euros and has begun to question the sustainability of that commitment, which in our view is very reasonable. Mm-hmm. So you've got the Swiss National Bank, who is also anticipating this week's European Central Bank, the ECB announcement of quantitative easing or debt monetization, and was likely afraid that the euro would continue to drop in value to levels that would raise the ire of Swiss citizenry. Because think about this. They've been buying euro paper.
Right.
And that's been to diminish the value of the Swiss franc and support.
Yeah, the value of the euro.
The value of the euro. Well, as the euro has been declining, they've lost 60 billion Swiss francs on this particular investment, if you will, in euros. And the point is, this could get a lot worse if you're dealing with a larger base of Swiss francs that have been converted to euros. The ECB has essentially pre-announced that $635 billion in purchases. And again, we look at that as something that the Swiss National Bank simply wanted to avoid.
Dave, there's also the concept of the carry trade. And the carry trade is just simply you find a country that you can borrow money in at a very low rate, and then you go out and loan it to someone else at a higher rate. Now, your worst nightmare in a carry trade is if the currency that you borrowed originally rises.
To go up.
Now, usually a carry trade is broken if the currency value rises 1, 2, 3%. We're talking about a rise of
20 to 40%. Yeah, so overnight, the Swiss carry trade ended. And that's exactly the mechanism. Borrowing in a depreciating, low interest rate currency and taking those funds and going and buying other assets. Mm-hmm. And that came to a halt without warning midweek last week. As a result, you've got liquidations in other asset classes, and that should come as no surprise. The impact of this is primarily in the hedge fund community. The large short positions in the Swiss franc were absolutely destroyed. And I think anyone who's paying attention should be very cautious. Those playing the same games in the yen have to be aware of the fact that the Bank of Japan sees the possibility for a sharp rise in yen, because you've got yen carry traders and short positions out the wazoo, which if they had to be covered would cause a significant spike in Japanese yen. In the same way we've seen in the Swiss franc, which has been one of the funding currencies for mass speculation around the world.
Well, the wrong people probably were short francs, but I do know of a couple of people that were long Swiss francs. I'm not sure if I'm allowed to say that, but I do know someone in the room who just happened to be long francs.
I happen to own a few Swiss francs, and yes, the benefit might be enough for a shawarma next time I'm in Zurich or something like that. But yeah, not enough Swiss francs to matter, but better to be long than short midweek last week.
Okay, so let's talk about the people who had taken these loans out. Okay, the currency that they're paying back in now is 30% higher. They're going to have to pay 30% more for it. Who has those debts? Who's going to take the pain for that?
Well, there's two people. On the one hand, you've got the foreign currency traders who are taking leveraged bets, and they just got wiped out. They owe money if they want to come back to the table. The second category, and this has been happening for years now, Swiss banks have loaned money to Eastern European countries, with individuals and corporations taking advantage of the low Swiss franc interest rates. Mm-hmm. Now negative interest rates. It's kind of like free money. You can see the appeal. Now, I'm thinking specifically of Hungary here. Then lo and behold, the currency moves higher. What was a cheap interest rate is now an expensive principal repayment. You see how it works?
Right.
And the principal having to be repaid because of the currency move is 20 to 40% or more. And this, in essence, in theory, there's differences, of course, but in theory, it's like debt has been indexed.
You know, it reminds me of what Bill King has been saying for a long time. You know, I was talking about filling the phantom gap, but this absence of correct pricing in all of the markets at some point is going to probably be filled, and filled violently.
Right. Now, Bill King, our friend, he said basically this is a template for the coming adjustments in other asset classes. I quote, "Central banks' incessant manipulation and interference in the markets in order to keep the welfare state and the big banks afloat is increasingly distorting the markets and making a return to normalcy more onerous. There will be no easy adjustment to normal markets. With each central bank intervention, the odds of a violent adjustment jump. The Swiss franc chaos is a template for coming adjustments in other asset classes," end quote. So bear in mind that collectively, the global central bank community is now up to $12 trillion that have been thrown at the markets to promote the idea of a return to normalcy. And yet we still have the results which remain elusive.
Sometimes you have to go back and remember early years. And Dave, back in 1992, I remember September of 1992, there was a sure bet in Europe as far as great interest rates. I know at the time U.S. Treasuries were yielding about 4 or 5%, but you could get double that in Europe. And the reason you could safely, quote, get that is because of a commitment that all the countries had made with each other to keep their currencies within about a 6% band. It was very similar to what we're seeing with what Switzerland had decided. You know, even England, who at the time was not part of the European Union. They had agreed to go ahead and set the pound so that it would stay within that bound as well. It's called the exchange rate mechanism.
Because currency volatility was essentially taken out of the equation, it was a question of choosing treasuries in the U.S. for 4 or 5% or choosing treasuries overseas for 8 or 10%.
Sure.
Because the volatility, again, of the currency fluctuations was taken out of the equation given the ERM.
And then it was broken, and the only person who made money on that trade, I think, was George Soros.
He certainly was one that made the most, other than the guy with perhaps a little pocket change in another currency. Now, it's slightly different than what happened, but the same mechanisms involved. An artificial value was being maintained.
Right.
And when that artificial value could no longer be maintained, in 1992,
it was violent.
It was the British maintaining the value of the sterling at a high level, and it should have been lower. And so Soros basically seeded the storm, if you will, and in the process of seeding the storm caused a central bank decision to occur, which took them out of the exchange rate mechanism and caused or forced an immediate devaluation of the pound sterling. The opposite occurred, but again, we're dealing with artificialities in the Swiss franc. There was the suppression, instead of the support of, there was the suppression of the value of the Swiss franc. And when the Swiss National Bank stepped away, we returned to normalcy.
Well, and I think for those who are trying to maintain perceptions, the last thing they want to see is gold rise. Yet in 2015, Dave, gold's up, what, 7, 8%?
Gold's up 8% in 2015. Germany has successfully received last year 120 tons of gold, 35 tons from Paris, 85 tons from New York. Gold in euro terms, if you're looking at a chart of gold in euros, it has finished its consolidation and is moving higher. So resumption of the bull market trend is in play in euros. It is in play in Japanese yen. It is in play in virtually every currency. And lo and behold, in U.S. dollar terms, we're sitting at the downtrend line at about 1282. And getting above 1282 breaks that downtrend line, as we've mentioned in the past. The technical levels that we've been looking at as hurdles to mark progress. 1250, 1347. These are prices that for us open the door to a 2015 return to 1600 with a potential for 1900 by year end. Our long-term price target of 5,000 is still expected, and we still see $165 silver. That's a 30-to-1 ratio, and there's certainly people who would think that 15-to-1 is a more appropriate gold-silver ratio at an extreme.
And there'll be volatility. I mean, there's going to be ups and downs before those levels are hit. But the other thing that we've measured in, Dave, through the years, we've encouraged clients not to just look at the dollar versus gold, but also what's the value of the Dow? How many stocks can you buy for an ounce of gold?
And that trend, I think, is in the process of resuming. We went from a 43-to-1 Dow gold ratio at the extreme in the year 2000 to about a 5 or 6-to-1 ratio in 2011, the fall of 2011. Since the fall of 2011, and this is the irony throughout our conversation, we had artificial decisions made in the fall of 2011, which both impacted the Swiss franc and gold. And we've seen the artificiality come out of the Swiss franc and a return to normalcy occur there. We think that you will see a return to normalcy in the gold market as well. That Dow gold ratio is now back in the double digits, and we think that it'll shrink to 8-to-1. That's our target for this year. 5-to-1 next year. 3-to-1 by the end of 2017. And my suggestion is that you own what you're going to own. If you're a conservative investor and you want to wait for price confirmation, then wait for gold to get above 1347 before backing up the truck. Aggressive investors would add between 1220, which is strong support, and 1350, a breakout level. As I mentioned, we're at the descending trend line this week at 1282, and we may consolidate here before we move to 1350. But I think it's time that we dust out the cobwebs of our mind and begin to look with different expectations to the gold market. Reality is impinging itself, just as we saw in the Swiss franc. Also, we'll see that this year in the gold market.
And we're seeing the impacts on central banking and some of these artificial price levels. But, you know, we now have a split government again, which many people would say, hooray, let's go ahead and try to keep them from being able to make any decisions, always arguing. But we do have a State of the Union that probably is going to have to be addressed as far as the smell of higher taxes seems to be back in the air.
A lot has changed in the last several years in terms of Swiss bank secrecy. So don't take this the wrong way, but money is looking for a place to hide. And that's why you're seeing money go into the Swiss franc and into gold. And again, there's no place to hide from a reporting standpoint, but there is a place to hide when it comes to extreme market volatility and the fragility which we see in the global financial system. Money is looking for a place to hide, and there is no doubt that after the State of the Union, and the reiteration of redistributive policies here in the United States, there are many reasons. Market volatility, central bank artificiality, and now you've got an increase in class warfare incited by the Oval Office. Quite frankly, the danger of the president's narrative is that it solidifies a governmental commitment to keeping as many citizens as possible on a Keynesian consumerist hamster wheel.
You can't save.
No, They don't want you to save. And they want anyone who is saving capital to be fleeced, to redistribute that capital to those who will be forced to, by economic necessity, to spend every dime. So we have this intergenerational thinking among the wealthy, which is questioned by those in power today. And in its place, the toxic seeds of envy and redistribution are being planted. I just wonder, can anyone imagine a statesman casting a vision for this country which has inherently unifying characteristics instead of being inherently cannibalistic?
Yeah, it seems like war is being incited from all angles, including, like you said, class warfare. But let's go ahead and talk about recovery here, because there are many people who have been buying into the unemployment numbers. You know, there was a lot of celebrating. We talked about it on last week's program about the unemployment number, but actually, without adjustments, it was bad news.
Well, that's right. I mean, we had the non-farm payrolls number, which turned a negative 65,000 into a positive 255,000, and everyone was excited with the end number. So no one questioned it. What's interesting, we stand corrected. We were very critical last week, saying that street pundits don't like to look at seasonal adjustments. Well, they do. They just look at it selectively. So here we have a Barclays economist who ignored the non-farm payrolls adjustment, that seasonal adjustment, but looking at the more recent initial jobless claims, which spiked higher to September highs, said this: we attribute the spike in benefit requests to the seasonal adjustment process. So when you have bad news, it's explainable and you can make it go away. But when you have good news, please don't use the same measuring stick. And that's what we do continue to see, is the light is cast in different ways at different times by your Wall Street pundits. Oil, I mean, what can be said? You've got last year in May, most people were thinking that the price was only going higher. As we neared $100 to $114 per barrel, you had 91% of traders who were bullish on oil. In fact, last May, large speculators had their biggest net long position ever.
Right at the top of the market.
Right. According to my friend Robert Prechter, he discussed this in this week's missive. The number is now, in terms of trader interest and trader bullishness on oil, between 3 and 5%.
Well, doesn't that mean, Dave, when most of the people are thinking one way, that the market's going to go the other? Are you looking for higher oil prices?
I think we're looking for considerably lower oil prices, but given the consensus that it can only go lower, you're probably going to see it bounce. So maybe a sizable bounce. We may have 1, 2, 3, 6 months of a move higher in oil. Our conjecture, as we mentioned last week, you have convergence of oversupply, which is not a permanent state of affairs, but it is the state that we have for now and probably the next 12 to 18 months. You match that up with decreasing global demand. And I frankly don't care about the demographic arguments of who's consuming what in Asia. We see a declining trend in the short run, as you see declining growth virtually everywhere on the planet.
Well, and that would include copper. We talked about Dr. Copper last week, but copper, I mean, it's going down like oil has been. Are we going to see a bounce in copper?
And that's probably a supply and demand related thing too. You've got the LME inventory, which most recently showed an increase. So you've got an increase in supply. And meanwhile, you've got lots of your uses which are down. Industrial demand, housing demand, et cetera, which is down given a slowing global economy. Of note, because the Chinese have a tremendous stockpile of copper, it's worth reflecting on volatility this week in the Chinese stock market. They decided to limit margin purchases, and they went ahead and penalized a number of banks who were getting excessive in their lending for margin purchases in the equity markets. I came to work a day or two ago listening to the National Public Radio explanation of this, and they brought on their economist, and he was incensed by how much money was being borrowed to buy stocks and how artificial this was. And
those darn Chinese.
It was normal to see an 8% correction. The froth was coming out of the market, and good for them. Slap, slap. They've learned a lesson. And I'm thinking to myself, is he oblivious to the scale of U.S. margin balance?
It's higher than any time in history right now.
Any time in the history of the U.S. markets, not only in nominal terms, but as a percentage of market capitalization or as a percentage of GDP, the amount of margin debt that is in play is near records here in the United States. And the same thing which occurred in China is not going to happen here. You know why? Because the Fed has taken it upon themselves to make sure that banks are lending cheap money and that margin debt is available. And we continue the gravy train of progress in the stock market towards an infinitely higher number. But again, this goes back, Kevin, to what we've been talking about all day today, which is, isn't this artificial? And what happens when reality comes back in and the markets have to reflect just reality, not the artificial inputs?
Well, Dave, we talk about shocks to the system. You know, obviously, very few people expected Switzerland to do what they did when they did it, and it had huge ramifications. You know, what we're seeing with Russia right now, you know, people need gas, people need energy. Frankly, in the middle of the wintertime in Ukraine, they need energy, and Russia's cutting a huge percentage of their gas feeds into Europe.
You know, again, most of us don't have family in Bulgaria or Macedonia, but that doesn't change the experience for folks in Bulgaria, Greece, Macedonia, Romania, Croatia, and Turkey. The gas that has been shipped through Ukraine, 60% of it has been shut off. And the Russians, through Gazprom, have basically said, we're not going to pump this through anywhere but Turkey because we're sick of Ukrainians stealing gas, basically siphoning off of the pipeline and not paying for it. So you've got, again, a subtle form of control, the Russians flexing their muscle, and a number of Eastern European countries being pressured. I mean, you realize that without gas, they are subject to the pressures of a variety of political interests. And so the game continues to intensify and increase in interest there in Russia.
Isn't it interesting? This is the same country, though, that may be cut to junk bond status by Moody's.
Last week, Friday, Baa3 with junk bond status on the horizon. And it's not out of the realm of possibility that in 2015 we see a default. What happened to the global markets the last time we saw a Russian default? Does anyone remember? Does anyone realize that there were hedge funds that simply got it wrong just a little bit, that almost brought the entire financial system to its knees? 1998, you need to replay that in your mind. Very little changed in 1998, except that the entire financial system of the world almost melted down. And we were in a reasonably good position if you're looking at the global economy at that point. We have the same issues of fragility and vulnerability now that we do then, whether it's Russia, whether it's looking at a declining growth rate in China. As we've mentioned in a past podcast, fingers of instability. You can pick a dozen different things that just don't look quite right and could actually in 2015 turn out to be quite wrong and uncomfortable. And you do want to be liquid in that environment. You do want to have a cash position in that environment. You do want to have a gold position in that environment. And the fears and concerns which we saw peak in 2011 and then just dissipate because of central bank intervention, they are reemerging. For anyone who's paying attention, the concerns of 2011 are back again.
You've been listening to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany. You can find us at McAlvany.com, McAlvany.com, or give us a call at 800-525-9556.
This has been the McAlvany Weekly Commentary. The views expressed should not be considered to be a solicitation or a recommendation for your investment portfolio. You should consult a professional financial advisor to assess your suitability for risk and investment. Join us again next week for a new edition of the McAlvany Weekly Commentary.